Obviously, we've seen, some record rallies, S&P and the NASDAQ breaking through to new records after the Jay Powell press conference and just kind of the assurance that we're going to get those 3 rate cuts. You're paying attention to financials in particular, both the KBW Bank ETF and also the regional bank ETF, both of them outperforming the S&P since Jay Powell's news conference. Why is that important? In your mind, is that a read on the markets or the economy?
I think it's both. So, I think when you think about banks, right, they are particularly sensitive to when the rate cuts are going to come. So, anytime you see a movement in the thoughts on when the rate cuts will come, they rally, or the opposite if it gets pushed further out. The other part is obviously they're very economically sensitive. So I think both things in terms of when we saw the move from Powell that really the June cut is really still on the table. It really put gasoline on the fire of getting those going again. So I think again that you could see it in the market overall as well.
A lot of confidence in that June cut, but there's questions about whether or not there's going to be actually 3 cuts this year. I was actually talking to KKR's chief investment strategist, Paula Campbell-Roberts, this week, and that firm, even after the Jay Powell decision, said they only see 2 rate cuts this year. Erin, I know you're in that camp as well. You're seeing only 2 rate cuts this year, but you're actually looking at a reacceleration of inflation, specifically when it comes to PPI. We're going to show the audience a chart of the month-to-month changes when it comes to PPI. So why do you think that's so meaningful, even after we heard Jay Powell basically say he's not as concerned about inflation?
Right. So I do think, unfortunately, that they are over-optimistic. When we look at the setup of where we are historically, there usually is a second wave of inflation, and that is often spurred by being a late cycle phenomena where we have tight inflation and tight commodities. And we have those 2 setups. On top of that, we have fuel to the fire with incredible monetary spending, fiscal spending, and we really are already looking at those tight commodities, and that's why I'm looking at that PPI, because that's what's concerning me. We've already seen these run-ups in metals, in energy, in cocoa. And so I think we really need to start paying attention to the signs that the economics are really telling us. And though the FOMC is trying to be optimistic and reassuring investors about those 3 cuts, I think as we go down that road, when we come to September, that they're going to have to start changing their tune.
You're not the only person worried about reinflation and the risk connected to that. BlackRock's Rick Rieder, he was on CNBC yesterday, really focused on services inflation.
Right, extremely.
Parts of the Fed's interest rate tool does not affect some of the heavy levels of inflation. You think about healthcare costs, education costs, insurance. So there's a dynamic, and part of why I think the Fed is right to say the last mile is hard, bringing down service inflation is very hard.
Erin, apologies for that. I should let you know we were going to play that soundbite. But I'm going to come back to you. It sounds like you agree with the take that Rick Rieder has.
And if you combine that with the commodity tightness and reinflation that we've already seen on that side, and that is also in part to tight employment, I think that's going to be very difficult to overcome. And so when we're looking farther ahead, particularly when we look at those dot plots and expecting, over the next 3 years, I think those are almost Pollyanna-ish and just really unreasonable. And I think they should have been much more conservative from their last projections.
So, Bill, I'm going to come over to you. I know, again, you said you're confident we're going to get 3 rate cuts this year. But what do you think about Rick Rieder's take on the idea of services inflation being stickier?
Yeah, no, I think that's the absolute biggest fear. Chair Powell kind of waved it away and said, the labor market's more in balance. And I do think, it's fair to say if there's any risk, it's that continues to bleed through to the overall inflation rate and won't allow it to us to get those cuts. So I think that is a completely fair thing, and what you really, as an investor, should watch the closest.
All right, so Erin, I'm going to get back to you. We're almost out of time, but very quickly, you're, Erin, a bit of a contrarian. You're actually worried about a possible recession going forward, and you're making some defensive plays. You're looking at tips and also gold. Gold trading pretty close to an all-time high right now. Why are you so bullish on these very defensive plays when we're seeing the market broaden out and a lot of people feeling very bullish about the outlook on things?
Well, it's really more just a contrary play. It's not necessarily that I see a recession. It's just that these are the plays that do very well when we have to do that readjustment and wake up and say, hey, there's going to be a second wave, which we have seen multiple times in history when you look at inflation waves. And so I think there are opportunities in gold, in industrial metals, and even in tips, particularly when you look at tips
Okay.
early in the cycle. Those are the ways to hedge and save your capital preservation.
Bill, I'm going to give you the last word. Agree with these? She calls them contrarian plays. I think some people would also see gold specifically as a defensive play. Agree, disagree?
I may not tilt that far. I do think you have to maybe lean into some more of the less cyclical areas, staples, other things, just because the market seems so sure that there's no recession. Market's probably right about no recession, I think, but it's really been priced in that there'll be no recession. So I think maybe there's more opportunity, maybe leaning a little away from that.